I would like to introduce our panel for this discussion. Our first panelist is none other than the Governor of the Central Bank of Sri Lanka himself, Dr. Nandalal Weerasinghe. With extensive experience in both the Central Bank and the IMF, Dr. Nandalal was also previously a director of the Board of Management of the Sustainable Energy Authority, as well as the Board of Investment. Welcome, Dr. Nandalal. With over 35 years of experience as a banker at DFCC, our second panelist is none other than the former CEO of DFFC Bank, Lakshman Silva. At present, he is engaged as a member of the Financial Systems and Stability Committee of the Central Bank of Sri Lanka, as appointed by the governor of the CBSO. Welcome, Lakshman. And finally, our moderator for this panel is Murtaza Jafferjee, former director of the Colombo Stock Exchange, CEO of JB Security, as well as chairman of the Advocata Institute. Over to you, Mr. Murtaza.
Governor, there is a new law that has come with regard to the running of the central bank. What has changed? It's 8 months since it's come into play?
First of all, let me thank, it's a very interesting discussion. I really enjoyed the early one as well. So this, I think the introduction basically helped me a lot about what has happened so far. I don't want to talk about it. Since the implementation, I think what we can see in central bank independence is, in a way, to me, is even early act. We had sufficient independence if this is to exercise by the members of the board who has been given the entrusted with the responsibility of exercising independence. But obviously there are some weaknesses, and as a result, those members are not able to exercise independence as much as they wanted. But still, as a governor, if you want to implement exercise independence, still we had the sufficient independence in the early act. A new act has strengthened and given the legal mandate and prevented any undue influence on the central bank operations, and also implementing monetary policy. All are very well established in the new law. So as far as I can say, we have been, even under the previous law, we have been trying to exercise the independence given by the earlier law, and we continue and now enjoy as under law. There's no government representative in the boards. We have a very independent board, and also appointment process is quite independent. We have more checks and balances in terms of the appointment, the fixed term. So once you are appointed, you have a 6-year term, and it's difficult to remove unless misbehave or do something absolutely wrong. And as a result, we have a sufficient independence through Parliament, Constituent Council approval for the all appointment. That's all good part. And also the accountability is again very important. Our accountability to the public, to the Parliament. Independence should not come at the expense of accountability. We are a public institution. We should deliver our objective based on the mandate that has been given. So we have been, I think, in my view, our current, the administration, the board, and the senior management, obviously, I must say, the staff, the central bank has always been trying to be independent as much as every professional staff. But it's the administrative board level that we did not see in the past, but we now give sufficient space for people, staff to exercise, use their professionalism, and also we take it very seriously. So far, what has happened is that I think we have, in our view, we have been able to deliver our mandate. I don't talk about what we have done. I think that's very well documented and very well known to everyone. Another part is the second objective, financial stability. That is where, although we have authority to maintain financial system stability in terms of regulating and supervising financial institutions, especially deposit-taking institution, that's under financial oversight. But still, as already pointed out, there are certain weaknesses in the existing law and also other laws governing all these financial institutions, especially state-owned banks. That is where I think the second step of reforms is, once after we have given the independence to regulate and supervise deposit-taking institution coming under our supervision. And then second part is to address the influence of the state on running businesses of the banking sector, deposit-taking institutions, especially two state banks, which has a larger share in the financial service sector. And also, there are again the similar issue that we were facing in the past is as a shareholder, how do you maintain the rights of the shareholder and how shareholders address a conflict of interest between running the business as a bank, competing in the market, and also ensure there is no undue related party influence in running business. That is where we had some issues where because those two banks, the two old state banks basically established under different enactment. So those provisions usually would supersede the, uh, our regulations and direction on the Banking Act we had earlier. As a result, now uh, basically revised the Banking Act. Now the Banking Act provisions supersede and we have authority over other two other legislation which those basically establish all the institutions. That's one good development, one good authority that we have. But going forward, I think this just only recently this was approved by the Parliament, enacted, and then we are in the process of implementation of those provisions. In that, I can talk about. There's a lot of measures that we have been looking at just to have a similar kind of governance, regulation, supervision like any other commercial bank. So state bank should also be on the same level, especially when it comes to appointment of board of directors and basically reducing the influence as a state-owned enterprises and giving them autonomy, and also having sufficient number of independent and board of directors and the expertise of those directors and the fit and propriety. Earlier Act, government usually appoints first directors and then send us for fit and proper. Then there's a conflict between those two areas. Now new Act says before any appointment, they have to get fit and proper first from the central bank, so that we can scrutinize and look at the appropriateness, fit and properness, and then only those can be appointed. And also we have a lot of provisions and authority if there is a misconduct, so we can annually revise or review the fit and properness. There are a lot of provisions I can talk detail. What are the new directions we are going to issue under the new Banking Act, which is amended Banking Act. We are in the process of doing that, so that we will continue to do that. There are already, we have implemented some, but we are in the process of doing a lot more. I can talk about in detail.
Okay, thank you. So let me break up all the issues. Let's talk, Governor, about monetary policy. Inflation targeting, I believe, was adopted prior to the new law coming in, and it's 8 months since the new law came. So what changed as far as monetary policy and the conduct and how these discussions happen?
The new important change that happened with the new law, the earlier, although we say we have been implementing inflation targeting framework as a monetary policy framework in implementing monetary policy, but that was not formally recognized in the law. As a result, what we saw in after 2020, we had long period of about 10 to 12 years of record of maintaining inflation around 5%, which is our target level that we set ourselves. And then it was breached because central bank moved away from the earlier informal framework and then moved into a what they call different kind of monetary policy implementation, what we call this famous money printing, all these things. But now with the new law, one important change is that the mandate, the target is given by the executive or minister. Earlier we said we ourselves set the inflation target, but that's not the right way. Now we have an agreement between the minister and the central bank board that we are committed and we are responsible to maintain medium to long term inflation of 5%. So target is given by the Minister of Finance or by the cabinet, and then we have the responsibility. So that's one thing, one important thing. Then if we fail to achieve the target and the inflation targeting, then we are accountable, we are responsible, we have to explain to the public, parliament, why we failed. We need to bring back our responsibility to take all the measures necessary and all the measures that we have been entrusted we can do independently to bring back inflation and the target. So that's it's given more responsibility and also accountability since then. That's why the new another important change is that we are trying to explain to the public is now our responsibility in terms of price stability is to maintain low and stable inflation at 5% for next 3 years as agreed under the agreement with the Minister of Finance. That can be extended or government can change it further in the future. But as long as the agreement is there, we have to deliver that. If we fail, as I said, so we have to come back. And also the important one, when we say inflation is the target, there's a bit of misunderstanding in the public. What is the exchange rate management? So that's where inflation targeting framework means we're trying to focus and maintain inflation at 5%. Exchange rate will have to be determined by the market without much intervention from the central bank. So the understanding is very important of the understanding of how exchange rate is determined, because in the past, central bank has been trying to fix the exchange rate or target the exchange rate as well. So it's now central bank has no target, no any nominal or real target on the exchange rate. Exchange rate should be determined by the demand and supply under flexible exchange rate regime. That is where the lot of questions we are receiving now. Why can't central bank fix the exchange rate? Why can't we give a stability to the exchange rate? Why can't we? It's difficult for us to do business if we don't know where the exchange rate would be. But people need to understand what we are trying to maintain stability in terms of inflation, the 5%. Once inflation is stable, then obviously if other macro policies are in place, exchange rate will automatically, this will be outcome of all those policies. Central bank cannot fix the exchange rate. That's the mistake we had. So that is important under new framework. Our duty is to maintain inflation at the level that we have agreed, and let the exchange rate be determined in the market based on overall medium to long-term economic fundamentals and short-term day-to-day demand and supply. So as a result, we are going to have kind of a flexible exchange rate like any other country in the world. The exchange rate cannot be fixed. So that's need to have a understanding of the businesses, people, that exchange rate is not something that can be fixed. And at the same time, for people to make some predictable decisions, what is important is that they are understanding exchange and also how to manage the exchange rate variations in terms of the market-based reason, like how to hedge your exposure, how to hedge the future exchange rate variations in terms of forwards, in terms of other instruments. There has to be instrument developed within the market. That is why other part we want to do is to develop the domestic foreign exchange market, which can absorb this kind of exchange rate variation and can provide hedging instruments for the people who are doing business on the basis of exchange rate, variation. So this important parameter when people determine, make their consumption and investment decisions.
I will shortly pivot to you, Lakshman, to get your views on the new monetary policy regime and how, as a banker, you see it. But Governor, a quick follow-up on that. You have a dual board structure. There's a monetary policy board. Can you explain, for the benefit of the audience, why we have that and what the focus and difference is?
This is thinking here is the dual board is one is fully dedicated to formulate monetary policy. So for its monetary policy formulation is highly technical nature, the work. So for that purpose, all of the central banks and anywhere, if this is a highly technical nature, we need a specialized board who can make contribution and who can understand all the technical integrities and the models, all the economic the complexities for the board to make right monetary policy decisions. For that purpose, when you look at the governing board and the monetary policy board, governing board now has 7 members, including the governor chairing. The governor is supposed to be a person who has a good understanding of both financial stability and also monetary policy. But then we have independent 6 members appointed through the process. But members of the governing board are not necessarily experts on in this subject, unless they have interest and learn. And it's not something that someone can easily understand and get their knowledge. But for example, in the governing board, we have experts in legal, experts on banking, experts on risk management, and governance, all the mix of expertise in the board, and accounting and all these other professions. But when it comes to monetary policy making, I don't think it's only governors should be expert in the monetary policy, but you need members who can support and make the proper informed decision. You need members who are much more knowledgeable in this. That's why, in addition to these 7 members, we have another 11 members where the 2 experts, those who have a better understanding of the economics and monetary policy, and in addition, 2 deputy governors who are also must be experts in their work or the career, are also members. So then the governing monetary policy board has much more expertise in terms of the governor, 2 deputy governors, and 2 experts. They have 5 members who are supposed to have a much more in-depth knowledge and experience in monetary policy making. At the same time, other members can bring in their expertise and their knowledge and their views independently as a private coming to independent members. Then there's a right mix of people who can make a better informed decision, especially when it comes to monetary policy making. That's the difference. That's why it's important to have this. In some countries, in fact, I want to say, monetary policy members are completely, independent, and they are not members of the governing board. So that's, I think, there was a lot of debate when we formulate this thing to boards. I think that's why we came to compromise. We need to have at least majority of significant number of people, members who have a good knowledge in monetary policy making. We have that board, and also the continuation of members who are already there in the governing board also had some exposure in monetary policy making because they were earlier responsible. So that's a good mix now. So that's the major difference in terms of monetary policy board. Governing board is obviously responsible for all other administration, consumer stability, EPA, public debt management, all are mix of. That's why you need a wide kind of the diverse exposure when it comes to other responsibilities of the central bank, the governing board.
Thank you. Lakshman, you heard what the governor said, and now there is a new monetary policy methodology. As a former banker and as a citizen, do you see a difference?
Thanks, Murtaza, for the question. I was watching the discussion that was going on here, and I was wondering why banking sector have been brought in here, because I personally believe the banking sector generally is not identified as a place where the corruption and the bribery and all those things happening. I mean, Sarat Jaman and a professor must be knowing if there is anything more. But we are mostly concentrating on this anti-money laundering and terrorism financing. That's a place where we are in. And we have 24 commercial banks plus 6 other government institutions, altogether 30 banks in the country, plus this non-banking financial sector. So these are actually the financial sector, when you really look at, is a very highly regulated industry. And it's governed by the regulations which were there in the past by the central bank. And as mentioned somebody previously at the presenter, the director bank supervision is totally responsible under the governor to make sure that the financial system stability is maintained the code of conducts and all that have been done in the banking sector. And so there's a big responsibility. So the new Banking Act that came into existence, before that Banking Act came into existence also, there were best practices that were adopted in the country, especially in the private sector. So there are lots of talk, discussions with regard to the few state banks, but majority are private sector banks. So private sector banks are well governed and managed, and also there are direct supervision from the central bank itself. I'm not saying that the state banks are not, but there were lots of discussion with regard to the appointments of chairpersons, appointments of the board of directors. As Governor mentioned earlier, the finance ministry used to make the recommendations to the boards, for the boards, and finally the fit and proper being cleared by the central bank thereafter. But as Governor mentioned, now the situation has got reversed, and there is a consultative process where it takes where the appointments to the state banks are also well scrutinized before the appointments are made. So the other legislations that have come from the Banking Act, new Banking Act, prior to these legislations have been issued, directions have been issued by the central bank, there have been a consultative process between the central bank and the stakeholders. And we were advised to implement certain things, the international ICAP, capital adequacy, capital augmentation plans, all that have been actually been looked at. Then the fit and proper evaluation mechanisms also have been changed according to the new Banking Act, the changes that are happening. So along with that, I think part of the new Banking Act requirements have been implemented already, and the banks are practicing those. At the same time, there are a few more other directives to come from the central bank very soon. With all those legislations that are coming into force, there will be much more scrutiny about the banking performances, the reporting requirements that are already governed by the Institute of Chartered Accountants of Sri Lanka and the central bank guidelines. But beyond that, there are certain other reporting channels that are happening. So all these requirements that will, once that is being implemented, I think as Governor mentioned, the Banking Act was only passed a few months ago. So the directions are now on the way, and when those are implemented, I believe financial sector, generally banking and non-banking both, will be governed to the maximum possible. IMF diagnostic study that had already put out for 8 months ago has identified certain important areas of strengthening. Those things also will be implemented very soon. So once those are also implemented, I think banking sector could be a very strong industry in the Sri Lanka. Not that I'm saying that it's not at the moment, but it is. As she mentioned at the presentation, it is important that central bank is doing a lot on this, educating the general public about these requirements, building the confidence with regard to the stability, continuity, transparency of the banking systems in Sri Lanka. I think it's going to happen, and it will be strengthened more in the near future.
Lakshman, before I try to go deeper into what are the elements of the new Banking Act, if I can come back to my initial question. Now, Governor mentioned about the conduct of monetary policy basically. But as a bank and a citizen, do you see any difference?
Yes, of course, there are certain guidelines that have been introduced. Now, banking, when it comes to the shareholding.
No, so let's talk about the outlook for interest rates and inflation. Now, they have mandated with achieving a certain target. So, for example, let's say that they are able to keep inflation at 5%. How would that impact banks? Always we have had very, very volatile, up and down it goes. So say you get inflation at 5% and you are able to lend like home mortgages or at 9%, etc. Would that be a game changer?
I mean, that will help the banking community. Bigger cry in the market is with regard to the volatile interest rate. As you mentioned, when the interest rates are volatile, it's not only the banking community that gets impacted, it's mostly industry, people, customers. Actually, if the customers do can forecast the future very well, especially the industrial segment. If they can, if they know what the inflationary targets are, where the interest rates are going to be for the next 2 to 3 years, at least 4 years, then they could actually plan themselves for better productive operations. And also the understanding and the relationship that the banks and the customer can have also is good. We had situations where the market interest rates vary very fast, in a very short period of time, especially the people who had borrowed from banks on average weighted prime lending rates. You saw in the last several years during the calamity. I think this is coming from about 2018 after the 2019 after the Easter Sunday attacks, then the COVID and the other economic downturn that we had. Along with that, the AWPLR, the average weighted prime lending rates have gone up to about 20s, 30s, and the people have been actually finding difficult to service the facilities. And also the contracted and the forecasted rates of theirs was very different. The profitabilities were different. So that's the reason I believe the government also had actually listened to some of these concerns people have been raising over the last few years, where the debt service have not been possible and the Parate action have been stalled for some reason. Whether I don't know whether it is a good thing, but it had now been implemented until December. So I feel such arrangements and the framework that is being introduced by the central bank for the banking community is going to definitely help the banking sector, but there can be impact. Now you see that the senior citizens are making a claim with regard to the revenue that they are making through their own deposits when the interest rates are low. So, I mean, it's not something that the banks alone or the central bank alone can do. The fundamentals in the market also have to change, and also the cost of living and various other things has to come down. If that is happening, then I'm sure definitely that it will be beneficial for the financial sector and to the general public as well.
So if I, yes, go ahead.
Add one more comment, this important one that I want to emphasize, why it is important the inflation should be stabilized and fixed for not only for the bank sector, as you mentioned, if the public thinks inflation, credible thinks inflation can meet on 5%, then that obviously ensures the stable interest rates for businesses. That is one part of the businesses is a cost of finance. That's why earlier, without proper expectation of interest rates, it almost be difficult, not only for banks, but also people who are borrowing from the banks to make their investment and consumption decisions with a kind of a predictability. That's why 5% inflation means we can maintain a stable, low interest rate regime, medium to long term. It's not only for the borrowers, but for any other one who basically make, so for example, decision to raise wages, decision to determine the margins that you need for you to run business. Finance cost is one of the components, but inflation is 5%. Then one can ensure your cost of production would be increasing roughly around 5%. Then your wages can also be not, inflation is volatile. Obviously, workers can ask for compensation over 5%, 10%, 15%. That has been the kind of a perception we had in the past. We need to anchor this expectation with the public that 5% will be the inflation. Then you make all the decisions, make your demands, and make your business decisions on the basis of the stable 5% inflation with cost of financing will be stable. That's a very important perception we need to establish by an independent central bank. And then obviously exchange rate is a business decision should not be based on the expectation exchange rate. Should be based on the anchor on the inflation expectation. That's why it's most important one for everyone is the inflation. People all say public enemy number one is inflation. That's why it's most important.
Thank you. Pivoting back to you, Lakshman, you talked about the new Banking Act. I'll first ask you and then ask the governor also to weigh in. What has changed? Do you remember what has changed in the new Banking Act?
Yeah, actually, the new Banking Act brings in, with regard to the capital part of it, there is a requirement that is being introduced, I believe. It was there already, but I think now it has been strengthened more. With regard to the ownership structure, which is an important aspect. This had been discussed many years on this matter. So now the things have been very clear with regard to the ownership structure. And also with regard to the investments from the government entities to in banking sector. So there are certain regulations that are coming in. So that's a shareholding aspects. In operational aspects, appointment of directors, of course, it had been there, but it had been now scrutinized little more into that. I believe Director Bank Supervision is not here, but I think the evaluation of the suitability of directors are now, it is being practiced little more with more regulations into that. Then of course, with regard to the financial reporting side, there are many new requirements that have been brought in, which will be very transparent, and earlier also the financial sectors used to report their financial statements quarterly, annually, semi-annually, but it is now little bit more onto that aspect. Then with regard to the managing of non-performing assets classification, there is another new requirements that have been brought in, along with the accounting standards of Sri Lanka. So there are many requirements with regard to the boards, the capital, the operations, and also the reporting side. So many things have been happening new, and some have been already implemented, some to be implemented very soon. But as I mentioned to you, this highly regulated industry, that is the financial sector, generally won't have much time to implement these things. These are adapted already. Even the IFRS, we adapted as fast as possible when compared to the other industries. So similarly, all the other regulations that are come on board will be actually implemented. Even with regard to the complaint management, customer complaint management, then with regard to the anti-money laundering and other terrorism financing, our compliance areas have been strengthened a little more than what it had been. So these are requirements that are coming from the new Banking Act.
Governor, if I can pivot to you, I mean, significant part of the section on financial sector supervision is about the state banks. You know, they are highlighting that there are problems there, that there are not enough directors, there are related party lending transactions, the governance, government ownership. Now, what's going to change? Is there a plan to change that whole framework?
I think there are some changes we have been gradually trying to implement within the legislation we already have, and with the working closely with the government in consultation with the government. Now, Banking Act amendment has given us the legal mandates to do that independent by the central bank. Let me just share a few things. So this central bank amendment came only recently passed, still not effective date is still not published by the speaker. That will happen soon in my understanding. So first part, when it comes to state banks, there are the summary of amendments I can tell you. There are provisions to address inconsistencies in the statutes of the state-owned banks. That's a key one. So they have People's Bank Acts, Bank of Ceylon Ordinance, all these things, and NSP, all they have different statutes. So under the new Banking Act, we can ensure uniform application across banking sector irrespective of their own statute. That is one important one. And also second one, we have provisions to ensure directors, CEOs, and key management personnel, KMPs, have relevant and adequate qualifications and experience when it comes to state bank. So their appointment process was different earlier. Now on the new Banking Act, we have the authority and provisions to ensure all the directors, KMPs, and the board members are appointment process is similar to what the private sector banks we have been adopting. I think that has been a well-established good practice. And also other part, important one is the earlier appointment of those people, social directors, government appoints, then they are in the boards, and then only we basically look at the fitness for privacy. But with a good understanding, we have been able to manage that situation. One, if there are not proper appropriate persons are not appointed, then we have a good consultation with the government, and then we have been able to manage that. But now in the new law, there has this need of prior approval from the director of bank supervision before the appointment. So that's a very much more important process where, without being asking the government to please, consider another person, before that we can do the test and look at the suitability, and then only these people can be appointed to the boards, not only the boards but also succession plan, the KMPs and CEOs. That's a other one is in terms of fit and proper. And other area, these different statutes have different limitations in the number of directors in the banks. For example, now Bank of Sri Lanka, I thought it's only limited to seven, and People's Bank had some number, but the new banking act, we have the provisions to basically override that provision, and we're going to ask all the state banks need to have at least minimum number of directors, and also with different expertise needed to run a bank. So that will come soon, because it's only at the early stage. Those are the important ones when it comes to the managing two state banks, regulations of the state banks under the new act.
The report also talks about that there should not be any regulatory forbearance, especially on the state banks. And an example would be that the Basel II instruments, Tier 2 instruments, have to be convertible. Now, both Bank of Ceylon and People's Bank, the instruments that they issue are not convertible instruments. One thing is that they are not companies, they are under ordinances. Is that going to be addressed?
Yeah, of course. When it comes to standards, obviously, there's a one provision earlier, especially exposure to the state or state-owned enterprises. There was a provision under the early act on the national interest. We had to give some forbearances when it comes to state-owned exposure to state enterprises, exceeding the single borrow limit, exceeding the certain facilities, so we had to accommodate that. But in the new law, but obviously we had to give some time to come into terms with exposure, irrespective of state-owned or non-state-owned. Banks will have to adhere to those standards when it comes to the exposures, state-owned or non-state-owned, that we are implementing and going to issue those direction. One thing. Other one is to treat different instruments because those are government guaranteed or non-government guaranteed. Those will be treated, especially by on the accounting standards. Those will be treated same as any other instruments. So obviously, government guarantees have a different kind of treatment, but so it's not necessarily based on the national interest or anything. It's purely based on the instrument. Everyone will have to treat equally, whether held by state banks or private banks. The treatment will be consistent across all the instruments held by the banks.
So, taking into a comment what Lakshman said about the connection between the financial sector and corruption, because of the very large leverage, you can misdirect resources, all the savings of the country. Now, two cornerstones of Sri Lanka's law has been about ownership of banks, 10%, group 15%, and 9-year rule on directors. Now, there are various actors in our society who think they can change that. Are you going to allow it to be changed?
It's an interesting question. First we all will have to understand these are the institutions who can take public deposits. So our responsibility is to protect the public deposit and depositors and their wealth. When it comes, this is why, as Lakshman said, this is a highly regulated industry. Why you need a regulation? Because they have been given a huge responsibility of managing public funds, public deposits. When it comes to managing public deposits, obviously, then there has to be much more responsibility, accountability, and better governance. That is where the ownership structure is one thing. This 10% or up to 15%, we should, I don't think, in my view, we should not relax that. There could be circumstances in terms of acquisition mergers for a period, that's okay, but still the principle is that when the shareholders are given the kind of authority to use public funds, and there has to be a proper checks and balances, and no single shareholder or group of shareholders should be dominating the related party business of banks, because they are handling not shareholders' money. Only 10% their money, 90% someone else's money. So when it comes to giving the responsibility of managing someone else's your money, public money, obviously we have to have proper checks and balances. That's why there has to be a shareholding limit. That I think I don't see any reason why there should be. And also, not only that, what we are seeing in historically legacy, there are cross shareholdings. Some key shareholders are trying to get control through various means, by acquiring through different ways and means, and by appointing directors, although we see non-executive or independent, but they have kind of ways and means to appointing directors and have a related party indirect influence. All should be addressed because it's public money. So I think we will ensure strict adherence and ensure this money are properly used, and there are key responsibilities for the board of directors and the shareholders also. Because shareholders has the right to have their dividends, a reasonable rate of return for their investment, as well as they have the responsibility to look after the deposits of 90% of the public deposits. That's why when it comes to this debate of, there are a lot of debate going on, why can't we increase the shareholding of a group or number of groups, and why should we give them invest more in one bank or several banks? I think this is the best practice. So that we should ensure that. I'm sure, I think our thinking is that we need to strengthen all these things with the main kind of interests of safeguarding public deposits and public money. That's our responsibility.
So I think the report also talked about this ultimate beneficial owner, that the supervision was not sufficient, and to use the FIU definition of UBO. My last question before we open it out to the audience, two benchmarks have been given. Your two agency functions, the Public Debt Office and the EPF, to be taken out. I think there's a closer deadline on the Public Debt Office. Give us an update what's happening there, and about moving the EPF away from the central bank.
Yeah, this public debt management office, when you come to central bank, there are two agency functions which has a direct conflict with our key objective. That has also been a legacy issue that we have been having. The one is the public debt management. Earlier, under the public debt management agency function, we have a responsibility to raise financing for the government at the least possible cost. The one conflict was that our direct ability to influence and finance the budget deficit through that agency function, that we have addressed that part. But still we have the public management. This is where the PDMA Act is almost finalized. And I think next week the bill will be presented to the Parliament, as my understanding. And we have looked at the bill. We also were very much involved in looking at taking out this debt management function to a independent, supposed to be independent agency under the Minister of Finance. And we still, one thing I have to ensure, we have the responsibility of regulating and supervising primary dealers. This is a financial institution. Primary dealers are financial institution. Still, we will regulate and supervise primary dealers, but debt management agency will be going out as an independent agency. I think this is where we need to have proper, I think earlier we talked about SEOBAC. When you have a different institution, independent institution, which can attract proper people to run that business, we need to have a proper financial and operational independence should be given. I hope that Act will provide that. I think we have consultation with all banks. That part is going on. I think there's a provision, government was 18 months transition period, because this is a highly technical function. The government, the new agency will have to develop the institution, recruit people, train them up to the speed, and then 18 months we will gradually move away. Then we do that. But I also want to mention, even though there was agency function, we have a direct conflict. Internally, central bank had proper governance structure, and there are several ways and means that we have had introduced to prevent conflict of interest between the monetary policy and debt agents. For example, in charge of public debt department or in charge of deputy governor conducting auctions can never be a part of monetary policy making. So we have clear firewalls in between. That's how we ensure. That's why obviously there have been instances, the issues that we had, but we have been able to establish a good institutional framework to address that conflict of interest when it comes to debt management. That's why we are seeing recent developments of debt management. Government has been able to raise without central bank financing, also at very close market rates, and that has been working. I hope that transition will ensure the continuous kind of this process. When it comes to EPF, obviously there's another thing. We obviously has in terms of resources on the central bank, that has a clear conflict because they are responsible for the members. We have to give them as a custodian of the fund, we have to give them a maximum return for the members. For us to give the maximum return, on one hand, we determine the interest rates as a monetary policy. On the other hand, we are managing public debt as the raising funds for the government. And on the third hand, this EPF is investing 90% in government securities, and also interest rates we determine, and they want to get the maximum interest. That's a clear conflict, obviously, there's no question. But we had internally institutional framework to ensure within the bank there are strong firewalls. I mean, in terms of governance structure of the EPF, I think to me, it's a very strong structure. We have been able to address conflict of interest between three functions. But now the question is that obviously we are very happy to take that function out because we have about 300 staff out of 1,200, including contract staff. Almost 150 of our staff is employed to run this huge operation. It's not only the investment fund and investment management, all the operations, refund, all this thing, a huge operational thing. I don't think central bank should be doing this business. But the question is that this is the biggest fund of private sector, about 2.6 million active and over, I think, 10 million accounts. And whether members have the confidence in taking this function out of the central bank. So may reason that it was entrusted to central bank in 1950, because there was no other institution who had the at least capacity, ability to manage this fund independently. If you look at the history, obviously there has been allegations, there has been instances, there have been a lot of allegations in management of this fund. All these things were there, but we have been able to basically address all these things. Now, even the management of the fund, EPF, is much more stringent and no conflict of interest. We have developed the institutional structure. But still, there's a conflict. I think, in my view, I'm happy as a central banker, we should not get this involved. It's up to the government or the members to determine to establish a new institution that has a trust and credibility and confidence of the members that this institution will be able to manage and secure and invest and give them a reasonable return, good return for their lifetime savings. The question is that whether we can develop that institution, whether we have the strong institution with accountability and the proper governance, all these things. I don't think it should be given completely to a private sector business to run that. Because one is that here we have no regulatory institution. Pension funds are not a regulated business. First one is we need to government should establish a regulatory agency to regulate not only the EPF biggest fund, there are several other, these similar funds are not properly regulated. Once we have proper regulations, like we regulate banks, then we can ensure proper practices are basically adopted by all these institutions. Then you can develop an institution who can run this and or can be taken back by the Labor Department. I'm not sure Labor Department has a capacity to do all these things as a government department. That's a different question.
Oh, I agree. I was involved 20 years ago for setting up an Office for Pension Reform, care of the World Bank. We have limited time. we can take 3 back-to-back questions. Okay, I saw one hand coming there. 2. Do we have a third one? Third one. Okay. First with the gentleman in the red shirt, red t-shirt. And then the gentleman with the white, he's putting up his hand, and then right in front. Yes, you go ahead. Please be focused to the topic at hand.
Thank you for the opportunity. And one thing I have noticed all the time is that when it comes to public media, they always talk about things about inflation, very simple things that needs to be explained. They are being misinterpreted and communicated in a way that people can't understand. Sometimes they make.
So what is the question?
So, can central bank YouTube channel, can they produce videos like what is inflation and create short videos so that public can understand these things better, so that they can make informed decisions on what politicians are talking about? So the better people are informed about these things, they can make better decisions.
Okay, got it. Over there with the white shirt, yes.
Yes, this question to the governor, request. I'm an American Tamil, part of the diaspora. The inward remittances which are coming in from the diaspora, all 4 communities, are not recognized properly. That's a general view in the diaspora. You are mixing it with the Middle Eastern workers and don't give any recognition to the diaspora. I would kindly request that even if you can't separate it.
Yeah, I think I got the question. We'll ask him to reply. And over here, please.
Thank you. My question is, Governor, you mentioned that the interest rate in respect to earlier regulation and vis-a-vis today's regulation will be set by the executive, will be given by the executive interest rate targets.
Inflation target.
Inflation targets will be set by the government. It can be potentially argued that, this will be counterproductive as inflation targeting, if set by the government, will be sort of outcome of possibly profligate policy executive decisions, which governments tend to do, and leaving the bank in a very reactive situation of then making the interest rate or doing open market operations. For example, a deficit financing, executive policy decision may lead to very adverse inflationary environment against which banks are always reacting. So how do you see this debate? It's not just in Sri Lanka, it's generally everywhere. How does central bank and executive balance it out in terms of inflation targeting? Thank you.
Got the question, yes. So he was about inflation education, recognition of remittances, and a broader question.
Yeah, I think I start from the last one. It's important and relevant to hear why inflation should be set, targets should be given by the different of the government, especially. I think this is where any kind of sovereign, and the government is elected by people. So when it comes to key macro variables, so overall stability, government has a responsibility on behalf of the people elected by them to determine what is best for the country in terms of inflation. So that's why it's given to the government, the elected government, to determine, given the mandate. Once mandate is given, there has to be institution who will deliver the mandate based on that's why even the new act was amended. There's a debate at the Supreme Court, and I also invited and got my input in terms of constitutionality. Why this is the link between the government institution delivering the public mandate, and why should that be linked to the executive? Is through this link. That is the executive authority to tell, you are a public institution, you have a specific mandate, this is what we want for the country. So that is why it should be set by that authority, and then we have to deliver it. That's a key principle behind it. If we say we will determine inflation for the country, I don't think we should not have that mandate. We are not elected institution. We are an institution with a mandate. We should not decide what we should achieve. This should be given. That is what we did not have earlier. Now we have. That's a best practice in my view. Given the people's right is to determine. If interest, there's a obvious conflict. If government say instead of 5%, you give us a 10% inflation, I don't think people will accept. Elect the people, the representatives of the people, can't go and say, they can say, bring down the inflation 2%. I want 2% inflation instead of 5%. But if anyone say, we want 5% instead of 5%, give us 10%. That is what people are asking. I don't think next time they will win the election. 10% means the interest rates will have it 13, 14%. So there's a inbuilt kind of the mechanism to ensure what is best. Will people have some say in that? That is the one. Second one on the remittances, I don't think that's also, this is where people will understand the role of the central bank. Why we talk about the remittances, it is important one for balance of payments. This is in terms of external stability, managing exchange rate. We are talking about and transparent giving information, how much of money we are getting from tourism, how much we are getting from tourism, remittances, how much export proceeds. But when it comes to policies of whether government should encourage the diaspora versus Sri Lankan workers, that's a different thing. I don't think central bank has nothing to do with that. It's a decision of the government to determine, to give some incentives for, say, diaspora who are willing to invest here. You can decide a framework to facilitate that investment. If the government wants to promote remittances from people who are working abroad, it's not central bank duty. Then Minister of Labour, someone can come up with a scheme, okay, we are giving some incentives for these people to facilitate making more money. That's a different authority. That's why I think, I don't want to comment on whether this part should be encouraged, other part. That's a different authority that has to decide on that. It's not the central bank. We are talking about remittance because that has implication on the balance of payment, exchange rate, and all this. That's the only part we our responsibility. And on the communication is an important one. I think I accept the fact that communication of monetary policy and system stability of central bank are very important. So monetary policy is a very complex subject. When we look at the literacy of Sri Lanka, a lot of people, we say we have a very literate population, over 90% primary, secondary, and tertiary education. We are very above. When it comes to financial literacy, I think it's very poor. I mean, relatively very low. Recent survey, financial literacy of this country, people is about, I think, 56% or something. That's a challenge. So how we can explain? I mean, I can see a lot of, even some of the university professors making comments in the media saying inflation has come down, but prices has not come down. It's obvious. Inflation is the rate of increase in prices. How do you explain the even simple concept? We are trying our best to educate people. It's a much more media support and also experts, analysts talking about these concepts in a simple manner. I don't think we have expertise. We have very good technical competent people, but we are not professional communicators. We need to get the help from the media and communication strategies to help us deliver the different complex, technically difficult complex concepts for people to better understand not only the inflation, it's a financial literacy. That's why we are going to see people get into all scams, illegal deposit taking, and people can easily be misled because they are not financially literate. That's a much broader issue that we all will have to get together and deal with. Educate, improve the financial literacy of the larger population. This will address a lot of things. That's even taxation. If people can understand why taxes should be paid and how this money are being spent properly, it's a communication of the financial concepts.
Thank you. On that note, Advocata's core function is about advocating and communicating using new media, especially to younger people. So we hope to play a big role in that. We are way out of time. Thank you very much, Governor. Thank you, Lakshman. Double deputizing for the DBS also. Some miscommunication happened. We are out of time. That's it for the moment.